Hey guys, it's Nick, and in this video, I want to talk about the Fed and inflation. The Fed is saying that inflation is transitory in things like housing, appliances, cars, because of shortages in lumber, computer chips, and that kind of thing, as well as the pent-up demand from the reopening of the economy. Looking at the price of gold and silver in the last few days really looks like inflation expectations have diminished a lot, especially since the Fed meeting yesterday. As a result of the Fed meeting yesterday, they now expect 2 interest rate hikes by the end of 2023. Does the Fed actually believe that? Can they see that far in the future, or is that just what they want the market to believe? Who knows? So let's take a look at the data around things like lumber, housing, used car, appliances, and see how much of that might be transitory and how much of that might be inflation that's here to stay in these prices. Now, does the Fed really know what's going to happen with interest rates 2.5 years into the future? I doubt it. And if you want to see an example of the Fed's great predicting skills in the past, look no further than May 17th, 2007, when Bernanke said, housing mess is largely contained. The subprime mess is grave, but largely contained, said Bernanke. Given the fundamental factors in place that should support the demand for housing, we believe the effect of the troubles in the subprime sector on the broader housing market will likely be limited, Bernanke said. And here's a chart of the S&P 500 when Bernanke said that, right about here. The S&P was close to like 1,600 and fell down to 666. So while the inflation we're seeing from pent-up demand and shortages may be transitory, we still have not seen the full effects of the $4.7 trillion added to the debt in the last 15 months or so, or 20% of all the money the U.S. has ever printed in its history. So let's take a look at some of the things that are probably transitory inflation and what you can do to protect yourself from getting caught up in these surge in prices. So this is the Manheim Used Vehicle Value Index, and you see it dipped during the pandemic in 2020, but has skyrocketed ever since. So should you run out and go buy a used car before they keep going higher and higher? Probably not. Used car prices are up so much because of kind of a perfect storm of semiconductor chips not being available to car manufacturers who cannot complete their cars. So because they have less cars, they are selling most of their cars to retail, and they're not making any cars available for fleet sales. At the same time, rental car companies were reducing their fleets last year during the pandemic and now find themselves scrambling for more cars when this summer season they find that a lot of Americans are staying within the US for their vacations and need a lot of cars, and rental car companies cannot buy fleet sales from the car manufacturers because the car manufacturers are making more money selling them to retail customers since they have a limited supply. So the car rental companies are going and buying used cars to add to their fleet. Used car prices will eventually come back down to their normal level. So if you are looking to buy a used car and you already have a car, you might want to hold on to the one you have, maybe put some money to fix it up a little bit to maintain it for a little while longer. Or if you have a second car and you were considering selling it, now would be a great time to sell it to get top dollar for it. And so the poster boy for the inflation story was lumber prices. And now the Wall Street Journal is saying lumber prices are falling fast, turning hoarders into sellers. Part of the big rise in the lumber prices was a kind of self-fulfilling prophecy where they had shortages, and so because of that, people tried to get ahead of it and start hoarding a whole bunch of it, and now they seem to be unloading it. Kind of like what happened with toilet paper during the pandemic, where people got a whiff of a shortage and they started stocking up and hoarding it, or the more recent Continental Pipeline ransomware attack, where people went out and bought not just enough gas to fill up their car, but they started hoarding a whole bunch of it with extra gas cans and things like that, accelerating the shortage. And here's an article saying lumber prices plummet. Is the roller coaster ride over? And these are the average prices of lumber, around $400 going back to like 2017. And this is 2021, up to like $1,200, a spike. And now it's coming down pretty quickly. And here's a chart of lumber futures. Between 2015 and 2019, the average is under $400. But here, this green line, 2021, it spiked as high as almost $1,700, and now it's all the way back down to $1,000. So it looks like the run-up is over, and eventually it's going to probably settle right back down to normal levels, maybe a little bit elevated, but maybe more along the lines of $500 or $600, not $1,000 or $1,400 like it has been. And so one of the takeaways here is that you cannot have rising prices forever without rising income to match it. So here is a chart of consumer buying plans for homes, appliances, and automobiles, and you see it's at the lowest level since like 2013. Buying intentions for major appliances is also at levels not seen since 2017 and 2011. And this is huge. Home buying intentions, monthly change. We haven't seen this big of a change since at least 2001. So if the prices keep going up, people cannot just afford to buy any price if their salaries do not rise with it. And this is a chart of home builder confidence and home buyer confidence. Home builder confidence is the highest it's ever been since 1985. And home buyer confidence is the lowest it's ever been since 1985. And what's interesting is after the housing bubble burst, the home buyer confidence was at its lowest, but home buyer confidence was actually ticking up and getting towards its highs. So home builders could have all the confidence in the world, but if home buyers don't have any confidence, then they will not go out and buy homes at these elevated levels. So is housing going to keep having these high yearly percentage gains? Most likely no, unless people's income rises to meet the level of these new housing prices. As you know, people buy on the monthly payment, not on the price. So if you can only afford $1,500 on a $350,000 house, if that house jumps up by $100,000 in a year, that's going to take out a lot of potential buyers in the market who can no longer afford that house. Also, you keep seeing these stories about sellers who put their house on the market and in a few days they got 15 or 20 different offers at 10, 15, 20% over the asking price in like a bidding war for these normal everyday houses. That's not a normal market, and that is definitely not going to last forever. So if you have an extra house as a rental or an investment and you are considering possibly selling it in the near future, now might be as good a time as you're going to get with these conditions we have right now. There's a saying that high prices are the cure for high prices, and low prices are the cure for low prices. And if you don't know what that means, is basically when something gets too high of a price, the demand for it reduces and the supply for it increases. In the case of lumber, when the price gets too high, people stop doing projects that they were going to do. They postpone them, they wait. Same thing goes with home builders because they have to raise their prices and they show that to their potential buyers and the buyers say, I can't afford it, so they cancel the purchase. And so that reduces the demand. At the same time, the suppliers see these high prices and they go and say, hey, let's produce more capacity to take advantage of these higher prices. And so more producers produce more and it brings the price down eventually. And as for the saying, low prices are the cure for low prices, a perfect example of that is the oil market. When the oil prices went down really low, the producers that had a high cost of production could not make money, and so they went out of business. And so that oil that they would have drilled came out of the market, came out of the supply of the market. At the same time, the demand went up. People were using more oil because it was cheaper. And so that eventually finds an equilibrium and the price eventually gets back higher because of those two things. So yes, I think inflation is transitory for those things that had the pent-up demand and shortages that caused these prices to spike so fast, so quickly. I think those prices will come back down when things normalize out. But the long-term effect of all this money printing on inflation has yet to be seen. And I think that is going to be the big problem going forward. Hit the thumbs up if you like this video, and I'll see you in the next one, guys. Thanks for watching.